So we are going to start from section A, external financial reporting. Question number 1. The financial statements included in the annual report to the shareholders are least useful. Mind the word, there is always one word or a combination of words that define what the question is all about. Least useful. To which of the following given in the options? First of all, the dynamic of the question is that you're talking about financial statements. Of course, external financial statements primarily made for external users. So we need to see the one that is not the external. Stockbrokers, they are external users of financial statements. Bankers preparing to lend money, they are external. They provide you finances, so they are outside your business boundary, of course, external. Competing businesses, they are also external. Yes, who are least likely to be using financial statements? Managers in charge of operating activities. They are more concerned with the internal functions of the business. They are more concerned with measuring the effectiveness and efficiency of operations. For them, budgeting is more appropriate. Return on investment, residual income, right? For them, that's what their concern is. Efficiency and effectiveness of operations. This is clearly the one that is least useful. So correct option is D. Next, when a fixed asset is sold for less than the book value, which of the following will decrease? Let us see one by one. Let's say you have an asset with the book value, also called the carrying value, $8,000. You sell it for, called disposal value, for let's say $5,000. So clearly there's a loss. $3,000 is the loss on disposal. Let's see what the question says. It says, which of the following would decrease? Mind the word decrease. Total current assets would increase. In fact, because when you sell an asset, long-term asset, so your current asset would increase either in the form of cash, or maybe the person who has bought that asset hasn't paid you anything, so that might result in a receivable on the balance sheet. So either cash increases or a receivable increases, which in fact is a part of your current asset. So current asset would increase. Current ratio, which is a part 2 domain, current ratio is equal to current assets upon current liability. Since your current assets are increasing, so that will cause the current ratio to increase. Net profit. Yes, since there is a loss on disposal is a charge against your income, so that would cause your net profits to decrease. That is what we are looking for. This is exactly the right answer. Net profit would decrease. Then it says net working capital. Net working capital is the difference between current assets and current liabilities. There is no change in current liabilities. We have sold an asset which would have brought cash or a receivable, so your current assets increase, which in turn increases your net working capital. So net working capital increases. See, this is the right way of doing questions. When you are attempting the question on the exam, you read each option, you weigh each option, you try to make sense of each option and select the one that is the best rather than just clicking options mindlessly. On July 15, the company entered into a 3-month agreement to rent a machine the company needed to complete the special order. The machine would be delivered on August 1st, and rental payments are to be made or due on first day of each rental month, right? The effect of this event would have on the balance sheet or on the company's July 31st financial statements, right? Just 15 days after this contract. We have just entered into a contract. We haven't paid anything. No cash has been paid. No expense has yet been incurred. Since nothing has happened, so there is no occurrence that requires any recording. It causes no change in assets, liabilities, or income because there is no recordable transaction. So that means BCD are totally irrelevant because there is not going to be any change in any of these. So clearly, all of you got it right. It's A. Next. All of the following are limitations to the information provided by the statement of financial position, except C. These are called negative questions. And these are the questions that many students get wrong. If you see the word least likely, if you see the word except, means these are the negative questions which completely turns the question upside down, right? So we need to look for all of the following are limitations to the information provided on the statement of financial position, except, means out of these 4, there will be 3 limitations of statement of financial position. One will not be. Okay, let's see. Lack of current valuation for most assets and liabilities. Yes, your balance sheet doesn't show all assets on its valuation. Mostly are reported on historical cost. That's a true limitation of statement of financial position. Omission of items that are financially valuable to the business, such as worth of the employee, competency of employee, capability, their commitment. They're all valuable assets, but they're not something that we report on the balance sheet. So yes, it's a limitation of your statement of financial position. Judgments and estimates used regarding the collectability of your customers, saleability of products, longevity of assets. Yes, we use judgments in these three dimensions specifically. And at the same time, it's a limitation of your balance sheet. Quality of earnings reported for the enterprise. This is totally irrelevant. Why? Because it is describing income statement. This is a limitation, by the way. It is a limitation, but it's a limitation of income statement, not the limitation of financial position. So that's why it's odd out of all. That's why it's a negative question. A is the right answer. Okay, next. A statement of financial position provides a basis for all of the following, except again it's a negative question. Let's move sequentially. Computing rates of returns. Rate of returns mean return on assets, return on equity. They are all possible. We can calculate them from balance sheet. True, correct. Evaluating capital structure. What is capital structure? Capital structure means if we have used 30% of debt in our long-term funding, 70% is equity. This is what you call capital structure. Debt versus capital is what you call the capital structure on the balance sheet. Debt versus equity. That's a detailed area of section B, CMA part 2. True, we can do that from balance sheet. Assessing the liquidity and financial flexibility. What is liquidity? Liquidity means it's the ability of a business, how comfortably it can settle its short-term obligations, how comfortably it can pay off its short-term liabilities. Whereas financial flexibility means how comfortably a business can respond to unexpected needs of cash, how we can alter our cash flows, how we can alter our financing arrangements to take benefit of changing circumstances. Both of these can be done or can be assessed through the balance sheet. Look at the last option, determining the profitability and assessing past performance. This is something we don't do using balance sheet because this is clearly your income statement. Income statement is what we use to determine whether the company is profitable, how good it or how well it has performed over the last period. So D is the correct option. All of you got it right. Excellent. An income statement could be used by an external investor for all of the following, except, see, most of the questions are negative questions. Let's move in the reverse order. Predict the company's future revenues. It's true. They can use revenue trends to predict future sales. True. Assess the risk of company achieving future profitability. This is true also. They can assess how risky future profits might be from the past trends of profitability. Compare the company's results to those of the competitors. Again true, because they can compare performance with competitors using income data, our data versus the competitors' data. What is not true? Analyze the company's performance compared to the budgets. This is debatable. Budgets are internal, right? External investors, they do not have access to companies' internal budgets, internal information. So this is something external investors cannot do. All of you got it absolutely correct. Warm-up questions so far. The financial statements that provide a summary of the company's operations for the period. Operations, mind the word. We know what it means. Let's move in the reverse order. The statement of retained earning is not the right option because statement of retained earning only shows changes in the retained earnings, not overall performance. Statement of shareholders' equity, incorrect, because it shows changes in equity accounts, not full operations. Statement of financial position, again incorrect, because it shows you assets, liabilities, and equity at a particular point in time, not for a period of time. The correct option is income statement because it shows you the revenues, expenses, profits over a specific period of time. So excellent, all of you got it correct. Now we are talking. This is something. Okay, so now we have an extended question. It says, Bertram Company had a balance of 100,000 in retained earnings at the beginning of the year and 125 at the end of the year. Net income for this time period was $40,000. Bertram's statement of financial position indicated that dividend payable had decreased by $5,000 over the period throughout the year, despite the fact that both cash dividends and stock dividends were declared. The amount of the stock dividend was $8,000. When preparing a statement of cash flows for the year, Bertram should show cash paid for dividend as. There is a specific recommended approach in doing this question. I would recommend that you should draw a tree account involving retained earnings, and then you should also make a T account for dividends payable. It will reveal some missing information. So what do we have for retained earning? Let me write down the full format first. You have the opening balance of retained earning, the closing balance of retained earning. Any income transferred to retained earning during the period comes on the credit side. And if you have declared any type of dividends, stock dividends, cash dividend, it appears on the debit side. So we have two types of dividends here. First is the stock dividend and second is the ordinary cash dividend. All dividends are paid out of retained earnings. So that's the format of your retained earning. Regarding dividends payable, if it's due, you would have some opening balance of dividend payable, some closing balance of dividend payable, some dividend that we were supposed to pay, it will come here from your retained earning, and the dividend that has actually been paid would appear here. So if you have this format, as you need to plug in the numbers, you will find the missing figure. So what we have the retained earning opening balance, which is given as $100,000 right here. It says the closing balance was 125 right here. It says net income for the year 40,000. It's just not the fill in the blanks now. Now next part is twisted. It says that dividend payable had decreased by 5,000 throughout the year, and company had paid stock dividend of 8,000. So what we know for sure that this is the stock dividend, 8,000. Cash dividend was missing. So we found out cash dividend by balancing this account, both debit and credit. The difference of 140 less 8 and 125 gives you $7,000. This is the dividend that we declared, and the entry we make when we declare the dividend, we debit retained earning, credit dividend payable. This is that credit, dividend payable. Mind it, this is dividend payable account. Now we don't have the opening and closing balance of dividend payable. What we have is that dividend payable balance has decreased by 5,000. That's the twist. That has the twist. Dividend payable balance has decreased by 5,000. We have to assume some opening balance. Take any number. Let's say if the opening payable is 15, the closing will be 5,000 less. This is the quick way to find the missing figure. Opening was 15, closing is 5,000 less. Now the balancing comes. 15 plus 7, 22 less 10. That means the dividend actually paid is $12,000. Some of you might find this computation a little bit longer, but this is a very safe way to find the missing number. So this format will be handy. Just you need to plug in the right numbers in the right place. You get your answer, and that is at 12,000. Okay, next. All of the following are elements of income statement except expenses. Of course, it's an item of income statement. Gains and losses, income statement. Revenues, income statement. Shareholders' equity. Yes, it is part of balance sheet, not income statement. Now the question that should be asking me, do we get such simple questions on your exam? Yes. Are all questions like this? No. Do we get difficult questions? Yes. The composition that we have seen over the last many years is that 20 to 25 questions are very easy, like these. You get one-liner questions as well. Around 50 to 60 questions are average, which are neither difficult nor easy. And then there are some 10 to 25 questions which could be very tough, hard and long, which may surprise you a bit. So it's a mixture of easy, average and difficult questions, and you need to be good at all. That's why try every type of question carefully. Whether it looks easier or tough, you need to have absolute grip on your understanding. The statement of shareholders' equity shows what? Let's see. This is the statement of changes in equity. What it shows you different equity accounts, retained earnings, accumulated other comprehensive income, common stock, additional paid-in capital, treasury stock, sometimes some reserves, capital redemption reserve, dividend equalization reserve, or debenture redemption reserve, they are part of all equity. So what it shows you the opening balance of your equity accounts, the changes that have taken place over the year, and the closing balance. So basically what it shows you a reconciliation of your beginning balance of equity accounts to the closing balance. What has happened over the period. That is what you call the statement of changes in equity. So we know what it shows. Let's move in the reverse order. Reconciliation of beginning and ending balances in retained earnings, wrong. Because that applies only to the statement of retained earnings, not to the full shareholders' equity statement. Incorrect. C says computation of the number of shares outstanding used for earning per share calculation. This is again a completely ridiculous option, because in EPS calculation, which is a part of your CMA Part 2 domain section B, section A, financial statement analysis. EPS calculations are done on the income statement, not here, and that's where we need the number of shares. B, listing of all shareholders' equity accounts and their corresponding dollar amounts. Not just listing, this is wrong as well. It shows changes in equity, not just a static list of numbers. Correct, all of you got it right. Reconciliation of the beginning and ending balances in the shareholders' equity account. A is the correct option.